Hi everyone, a very good evening and a very warm welcome to all of you on yet another Edelweiss Konnect Classroom program. As usual, we come to you on a monthly basis and share with you some insight which helps you make better and informed investment decisions. The topic today that we have chosen to come, I think, is a very relevant topic with regards to how we think and perceive our investment decisions. It's called Behavioral Insights into Investor Perception and Risk Tolerance. But before I get into the topic, whenever we make any decision, whether it's investment or no, but more so an investment decision, the idea is that we believe that most of us are rational thinkers. Now, what do I mean when I say rational thinkers is, whenever I'm making an investment decision, I decide on investing my money into that security, into that asset class, which I believe at that moment is the best to give me the returns that I wish, or it's the best at that point in time in terms of the investment outlook that I'm looking at, right? And so if you think that equity markets will do well, you put money more in equity markets. If you think that, equity markets will not do well, maybe fixed income has a better scope, you'll put over there. Maybe it's real estate or whatever, right? So this is what we call a rational thinking. You evaluate your options, you look at what data is available to you, what you decipher from that data. And then basis that you make a very rational decision. All of us as investors do that. But more often than not, what also happens, is in hindsight, we think that probably this was not the most optimal investment that I made. Some other asset class has perhaps given me a better return or given someone else a better return, or I'm reading that that's happened. And so, what this clearly tells me is that on a lot of occasions, especially when it comes to investment decisions, I do not make rational decisions. And this anomaly, that we have, is in between thinking of what we are doing and what we should actually be doing, is something which, behavioral finance or gives us insights into more of the behavioral insights. Because what happens is, whenever we make decisions, it is not only, even if I think that, I'm looking at data in a very unbiased manner and, making decisions just basis data. The fact is that it is not only data which pushes me into making that decision. A lot of that comes from how my mind perceives information that is coming. And that is why, keeping and controlling this behavioral aspect when it comes to investment decisions becomes a very important aspect if I really want to optimize the probability of me making returns. And that is what I'm going to try and do today, is going to tell you about what are those behavioral traps, what are those behavioral biases that we fall into. And because of this, in a lot of instances, we perhaps don't take the rational decision that we should for our investments. As usual, please put your questions and queries in the chat, and I will respond to each and every one of those towards the end of our session. So on that note, let's begin, and let's start, and let's first talk of investing. For a lot of us, when it comes to investing, we think it's a very easy decision, right? I mean, you read that, this asset class is doing well, I invest there. You read something about which finds your interest, you invest there. But very honestly, when it comes to investing, in our mind, there are a lot of questions, queries, and it's very complex. Right? Why am I investing? Do I want consistency? Do I want returns? Am I investing for the long term? Am I investing for the medium term? Am I investing for the short term? When should I start? Should I invest regularly? Should I invest in lump sum? Should I diversify, or should I create a focused portfolio? How much risk can I take? Should I look at protection? Should I look at wealth creation? or wealth building. There are so many things which actually cover and cloud my mind before I actually come to a decision of where and how much should I invest. So very honestly, if you honestly ask me, investing, even though it seems very simple and we think that it is a very, very easy, I can do it on my own. It's a very, very complex thing with a lot of things going on in my mind before I actually come down and filter out that complexity to come to a very, very simple investment decision. It's not simple, it's a very, very complex thing. And to top this, when you talk of investment options, we have so many options today. Earlier life was simple. When I look at my parents, they are very simple. In terms of investment decisions also, there were very, very few investment choices. Today there are so many choices that we have, when it comes to investing. You want to invest in real estate, you want to invest in stocks. Even in stocks, the various subclasses, are so many. Should I go for active? Should I go for passive? Should I go for diversified? Should I go for thematic? Should I go for sector? What kind of theme, what kind of investment strategy, what kind of investment philosophy should I follow? When it comes to bonds also, there is so much more beyond just the regular fixed deposit that is now available. And this, very honestly, and then not to say that there are newer options. People are investing in alternate currency. People are investing in art. People are doing so many other things. So very honestly, there is so much there, of an option today, that this actually adds to my confusion rather than simplifying things. And hence, when it comes to investing, it becomes very, very important that I either do my own research or get help, but make a very, very informed decision. And that's something why we should be very, very closely tracking my investment decisions too. Then when it comes to the major problem in our investment decisions, and this comes because there's a very, very asymmetrical value function in the way I perceive gains and losses. When I make a gain, I'm happy, but that happiness is short-lived. But the same amount of loss stays with me longer. Let me give you an example to extrapolate and explain this better. Imagine you're walking on the road, okay, and while you're walking on the road, you see a 200 rupee note falling. Now this is a gain, right? And when you see that 200 rupee note, you pick it up. You feel happy, isn't it? That, wow, I found some extra money. Now, you may decide to do whatever you want to do with it. You may decide to give it to somebody because, you don't want it. You may decide to go and buy something and you consume it yourself. That's a different story. We're not getting there. But you'll be happy, right? Because you gained something which was perhaps not planned. Okay. So that gain gives you happiness. Okay. But now let's imagine on the other side. Let's assume that you're walking on the road, and by mistakenly, you dropped 200 rupees on the road. You didn't realize it. In the evening, when you reached back home, while you were keeping your things back in its place, you realize that you are 200 rupees short. And then you start thinking, I had this 200 rupees in my pocket. Where could I have lost it? Then you realize, oh, it was raining too much, or it was too sunny. And, while grappling through the traffic or while crossing the road, I was rushing and my hand was in my pocket. And while removing it, perhaps I dropped it. And then you further analyze it that this was so stupid of me. I should be a little more careful. Today it was just 200 rupees. Tomorrow it could be more. And, I should be very, very careful with my money. And I should not lose it. Why am I doing so much extra when I'm losing that amount? Because that pain stays with me longer. I feel that I should not be losing money. Even in investments, the same thing happens. When you make money, you feel, yes, that was the idea. I invested because I expected to make money, right? So you feel happy, but you don't feel elated, joyous, thinking, wow, I have made money, right? I mean, you feel, yes, that was the idea, right? I expected certain returns. I made the returns. And you feel happy, and that's it. You move on. You start thinking, what should I do next? Okay. But when you lose money, when markets are not going your way, when your investment is not going in the direction that you wanted to go, and sometimes the volatility is there, you start feeling sad, you start feeling painful, and you start analyzing and over analyzing this stuff. Why is this happening? What am I doing wrong? Am I the only one who's doing something wrong, or everyone is suffering? Or everyone is making losses? That over analysis and something we keep on doing, because that pain of loss stays with me longer. Same amount gain, I'm happy. Okay, it was expected. I feel okay, fine, that's good. But that was what I was expecting. But if I lose anything, that pain of loss stays with me longer. And this pain of loss is something which makes me make some irrational decisions. Because I start thinking, am I doing something wrong? Is something, which I'm doing is something which, is not as per expectation, as per, what mistakes am I making? And then, you want to take corrective action, you want to change course. And in that, you may perhaps make some or the other irrational decision. And that happens with all of us. It's happened with all of us. It will continue to happen. And it is very, very important that we stop that by looking at it first from a distance and understanding that, okay, this is happening to me. And if it is a genuine mistake that you made in your investment decision, yes, course correction should be done. But if it is something where you think that this strategy will still pay out without being too rigid, it may not be a bad idea to hold on. So, but yes, that pain hurts. And that is why the probability of me making irrational decisions becomes very, very high. This is what we call the fear of losing money. When I think I'm losing money and I will lose more, I make irrational decisions and adopt irrational behavior, which then brings us to this concept called prospect theory. And like I said, when it comes to prospect theory, you value your gains and losses differently. And very honestly, you look at it, from a perspective of how you are perceiving things. So let's assume that you're talking to somebody, okay, and you're talking about what you think about investing in today's markets. And I'll give you two views first. Okay. Let's say you meet one person who says, no, the markets are overboiled today, maybe there should be some correction, and right now it's a wait and watch. And this is what even you are perceiving, that today are these levels a great level to enter. So you'll say, yeah, I agree. Because you are also thinking on the same lines, that is this market overboiling? So this person is just validating what you are thinking. So you agree. Okay. But let's say, at the same time, you meet someone else who says, oh, this is a great time to enter, we are entering a great phase of growth, and, this is the time when you should invest more. And, it's a great next 5, 7, 10 year that I'm looking at. And, there is good money to be made. And if you are in the first thought, you will not agree with this person. No, I don't think this is a great time. So you look at it differently, because your memory is telling you, no, this is not a great time. Your behavior is telling you that it is not a great time, because there may be potential loss. But let's say you are also in this same direction, that nay, I'm also thinking in the next 4, 7, 5 years are looking good, and this guy is now validating me. So then I'll take the conversation forward and ask, where do you think I should invest? Why do you think I should do that? Because now I want more validation and I want more direction. So that is what prospect theory does. You look at it from the perspective of your lens. When I share information from my side, if you concur with me, you move forward. If you don't concur with that, you will think that, no, this is not how it is. I look at it from different side. And that is where, we look at things differently. And that is what prospect theory basically tells me, that I will react to things, the way I look at potential gains and losses. If I think that there is an opportunity for potential gains, I look at things differently. If I think that there is a probability of potential losses, I look at the same thing differently. This uncertainty is what, of what I think, or how each of us as individuals think, makes us all unique. And that is why we make different decisions looking at the same situation. Now let's come to this concept called behavioral finance, right? And behavioral finance basically talks to us about how we look at market anomalies, and how we react to the rise in markets or fall in markets. Let's say if we are talking specifically of stock markets, and it's basically a subfield, behavioral economics, right? But what it's telling me is, how I react to situations, and hence what behavioral finance is, very honestly, is a very, very personal thing. Somebody who's been now in the market for, let's say, 15, 20, 25 years, he'll look at things differently, or maybe still react very, very unnaturally, even though he's seen, the volatility in the market. It's very natural. So how I react, and that is why behavioral finance becomes very, very specific. It could be very, very individualistic. Now, to be very honest, a lot of us think that behavioral finance is something very, very new. It's something which, in the last 5, 7 years, some people have been reading about, talking about. But very honestly, behavioral finance has been there since 1974. So it's almost a 50-year-old concept. And when I was researching about it, I was also very surprised that it's 50 years old, right? And basically, it was a study done by two gentlemen, who looked at how the expected market utility theory and efficient market hypothesis, which predetermines my returns, is basically not how things work, because eventually, you know whether I will make returns and how much returns will I make is basis every individual decision. So how you make a decision can be different from mine. How you look at things will be different from mine. And hence, how this entire thing, is so susceptible to biases, becomes the study of behavioral finance, or becomes the origin base of behavioral finance. So when we talk of behavioral biases, very honestly, there are five different biases that we'll talk about. We'll talk about what herding is, what overconfidence in markets does, what anchoring is, what mental accounting does, and what is an emotional gap in the markets. But more importantly, what I'll do is, instead of just giving you theory, what I'll tell you is how we can work at avoiding this, and why it's important for us to avoid these biases and psychological influences. Okay, so let's first start with herding. Herding, as the word says, it's basically the herd mentality, right? Following the crowd, that where everyone is going, I am also going. If everyone is saying, wow, markets are doing well, I've made money, I also start thinking, I should also make money, I also start putting. If everyone talks, mid cap is looking good, then everyone starts investing in mid cap. Everyone starts talking, small cap is looking good, everyone starts talking, starts investing in small cap, without realizing whether I am adept at taking the risk of that small cap scheme. But basically it's because what's hot today, what are fads, FOMO, as the millennial or the Gen Z generation says, so basically it's herding, where you follow the crowd. I don't know where we are going, but from the look of the crowd, it's got to be good. And this is when we be careful. Because what usually happens is, when a herd gets created, you usually see asset bubbles get created. And then sometime or the other, unfortunately, the bubble bursts. And when the burst happens, we see market sliding down, and that's when, we start thinking that, oh, I'm not making the money that I expected. So herding is a very, very common thing. You start seeing all around people talking investments, people talking about how they are making money in investments. And you also start thinking that I should also do that. A lot of examples where we've seen, the herd behavior, whether it's buying or selling, on both sides, to be very honest. Even more recently, the COVID times, when COVID started 2020, people were selling. By the end of 2020, 2021, people were, doing some manic buying in the markets. Even as early as sometime, early this year, people were buying a lot of small cap, which without understanding whether the risk appetite of that is something which they are able to tolerate. So the one thing that we all have to do is we have to avoid falling victim to this herd instinct. How do I do that? You know, before making any investment, always look at it whether this fits into your investment criteria, whether you're okay with the risk that this investment brings to the table. Understand, analyze, make better informed decisions. Just because somebody else is doing it doesn't mean I need to follow. So first is obviously, stick to basics, always understand, evaluate whether this investment fits into your investment criteria and your risk tolerance. Don't let emotions take over. Okay, don't, just because somebody else is doing it doesn't mean you should also do it. And third, maybe adapt contrarian strategies. Now, this is easier said than done, but think about it. When everyone's buying, you sell. When everyone's selling, you buy. Yes. So there are people who take contrarian positions. They make money out of contrarian positions. But like I said, this is easier said than done because you're going against the tide. If everyone is buying, you're saying, no, I want to be net seller. If everyone's selling, you're saying, I want to buy. It is difficult to do. But if you have, the emotional hold, maybe you can even try and looking at it from a contrarian view. But even if you can't do this, ensure that you're doing the first two. Make better informed investment decisions by evaluating investments and checking whether it checks, and works with your risk tolerance. And ensure that you're keeping your emotions as controlled and as away from your investment decisions. So avoid the herd. Second is overconfidence. Now, this is also very common, especially in bull markets. When markets are doing well, I start thinking, wow, see, I'm making so much money, I should invest more. And, I start going, all in terms of investment, specifically in equity markets, because when the returns spike up, you start thinking, wow, this is so fantastic. I should have started earlier. I should have invested more. Better late than never. Let me do it now. And what this actually does, you start getting overconfident. See, confidence is a great thing. If I'm confident, that's good. But if I'm overconfident, that's not good for not only investments, for any decision. Let me give you an example. Okay, there was a survey some time back which was done, and 70% of a driving survey of how well you drive. Okay, and 70% of the drivers thought that they were above average. Personally, if I were to rate my driving skills on a scale of 1 to 10, 70% said I am above average. So on a scale of 1 to 10, average would be 5. Let's say, but 70, now that is not possible, isn't it? The average, how can the mean be greater than this? So very honestly, this basically happens because I think whenever I'm driving on the road, I am not making a mistake. It is the other person. I always rate my driving skills higher than better. It's a mundane activity, right? I've been doing it for so many years. I know how to drive. I've been driving on these roads, and all of these. I know these roads like the back of my hand. Or I'm driving my car since so many years. I've been doing this. So I rate my skills others. It is not about how you rate your skills, over others. It is about how others rate you. Over here, that becomes very, very important. It is about having a self-actualization space that no, it's my fault. Unless I accept that, I will never be able to correct it. Similarly, when it comes to investments also, when you're making investments and the investments are generating returns better than your expectation, you start thinking, see, my investment decision skills is fantastic. I see all my decisions, all the schemes that I've chosen, all securities that I've chosen, everywhere that I've invested, I am in the money, I'm doing fantastic. Then that somewhere, builds confidence first that I may be doing something right. But very soon, this confidence grows and it becomes overconfidence. And it needs to be controlled because overconfidence is often detrimental. Now, how do I avoid it? Remember that I am not the only one investor in the market. I am not the only one that's driving the market. Along with me, there are many others. So it's not something which is a single person phenomena. Always remember that, even very, very successful and large fund managers have sometimes made mistakes, right? And so a mistake is normal. You cannot always get it right. You cannot always be on the right side. Sometimes you will go wrong, and it is very, very normal for it. So when it's remember it more as a humbling experience, humbling thing, that when people who do this day in and day out, when people who have more data than you, when people who have access to more information than you, can also sometimes not get it right all the time. What do I say about you and me as individuals? It's it's very, very common, and hence, be confident that you made an investment decision. This investment decision will play out, but don't let overconfidence get the better of you, because that's when I will start making mistakes. you know so that's the second one. The third is anchoring, and this is also very common. I've been privy to information in that side where every one of us anchors our decision making basis some or the other data. Some people will say this market is at an all-time peak, so I'm anchoring that this peak is not a great number to invest in. So PE, low PE is great for investment, is another anchoring that comes in our minds. So we always anchor on some arbitrary figure, you know, and this anchor then colors my mind. You know, we've seen enough peaks which are now seen as, oh, this was, we just getting warmed up. Low P again, I mean, maybe a great start point for a lot of people, but it may not always be great, because what is also true is when you look at markets is, most high performing stocks are at a high PE multiple. So if it's at high PE multiple, so does that make them not great? No, not necessary. Right. So point is, I anchor, and then this anchor, over a period of time becomes very rigid in my mind. Benchmark performance, I mean, if your scheme doesn't beat benchmark, you start thinking, "Arey, my scheme is underperforming." Now, that's not correct. Now, whether it beats benchmark or no, what is important for me as an investor is whether it meets my investment expectation. So let's assume that, when you made an investment, as an example, you were expecting about 12 to 13% of return. This scheme that you invested into has given you 15%. The benchmark which this scheme is following has given 18% return. Now, a lot of us start worrying, it didn't beat benchmark. Now, point is, my expectation was 12 to 13. I've got 15. I've got 2 to 3% more than my expectation. I should feel happy. But then this becomes an anchor. No, it's not beaten benchmark. No, it may have not beaten benchmark. It may have reasons for it. Find that reason out. Talk to your, investment advisor if you have, or a MFD if you're going to, or any person who's helping you make investment decisions as to why it has not beaten benchmark. But this does not make the scheme bad. Similarly, if you're doing your own thing and investing on your own, do your research, find out what happened, get on calls, or most fund houses have these open calls with their investors about what they're doing, so to understand what's happening, but point is, this scheme has done well for me because my even better than expectation from that's where the anchor comes in. I've anchored that it has worked, but still done well for me, better than well. So, which and that is where I need to look at things. Look at now. Why has it not met my expectations? Is a more valid question. Then why has it not beaten benchmarks? So understand recognize the anchoring bias that we all have succumbed into and try to avoid it as much as possible. So that's the third bias. So, how do I avoid anchoring? Be careful in your selection. Understand that it is not about the benchmark. It is about how much am I making. And basis that, make your investment decisions. The fourth one is mental accounting. So we've got into this habit of creating buckets of investment. That this is for my retirement, this is for a holiday, this is for my new house, this is for my new car, this is for my next mobile phone. And I bucket these investments. And some people even go further that these are safe, this is speculative, and then basis that I create a more I take certain more riskier portfolios, bets in that speculative portfolio, but my safety net has to not be touched. So that is also another way of I but the point is I bucket my investments. Now I forget that money is fungible. What is more important for me is net worth. Imagine you have created various buckets of investment, but something emergent, some emergency comes. What will you do? Will you say, no, I can't touch my house money? You will, right? Imagine you didn't plan for your child's education, but he's doing well. And, now is the time when you have to fund his education, but you didn't think about it. So now there are two choices. Either you delay your house, or you think, or you take a loan, or you tell your child, no, I can't fund it. Now, third option, most of us will not take, right? Now, either you will take a loan or you will say, now I can delay my house because my child is going out to study. So why do I need a new house? I am okay where I'm staying. So you will move that. But that was not the plan. But you'll do that, right? Because eventually what is important is net worth. How much money I have, where I have. If there is an emergency, I'll pull it. I'm giving an example where you could have planned this, but an emergency could be that, I've met with an accident and I need money. Now, wherever money is available, I'll take it from there to pay my hospital bills, right? So remember that money is fungible. If you have money, you have money. That is why net worth becomes important. If I want to grow my net worth, what is important is I cut down on some expenses and increase my investments. Check my investments. If it's not creating the returns that it should, then I should move it to higher yielding products. Of course, basis whether I am able to tolerate the risk and assess the risk better and then make those decisions. So avoid mental accounting. That's the fourth one. Similarly, the next one is this emotional gap, and we've done this program. We've done a program before of how can I keep emotions out of investments, and there are, it's a very, very interesting program, which is there on our YouTube channel. But this is something which is still very, very common, prevalent in all of us. Whenever markets are doing their thing, some of the emotion impacts me. If markets are doing well, I feel good. I start thinking I should invest more without, looking at whether I'm able to absorb the higher degree of risk of higher investments. When markets are falling, again, I start thinking that, now markets are falling. This is not a great time. I should remove my investments. Again, what do I do with removing this money? I may start putting it somewhere else and, markets turn and, I see that, it's created a missed opportunity for me, So I need to keep these emotions out. I need to stick to my long-term plan. I need to stick to my investment fundamentals. And only basis that make investment decisions. Try to fill this emotional gap and avoid it totally. It's important to understand how much risk can I take. It's important to understand why am I investing, where am I investing. So make a very, very informed investment decision. But don't take irrational decisions just basis emotions. This is the fifth gap. Apart from this, there are some more traps, very, very common traps that we all fall into. First one is obviously the heuristic bias, where we are stuck with a certain idea. And this is how it works. So, when I started working in the mutual fund space, financial planning became a buzzword. And financial planning at that point in time was a long course. So a lot of people used to ask, is there a shortcut to understand how much investment should I invest in how much percentage of my investment should be in equity? And very soon people started talking that subtract your age from 100, whatever number comes, that much percentage should be there. Now there is no basis for this. A lot of people have got stuck with the idea. There's no basis. I know somebody who's 75, heavily deployed in equity, because he says, I've done everything that I could. Now I want to. This is what ensures that I get up in the morning. It's what the motivator is, and I want to do it. Absolutely nothing wrong. I know somebody who's 35, extremely risk averse, and doesn't want to take any risk. Again, if my risk doesn't allow my tolerance of risk doesn't allow me, I should not do it. So heuristic, that's a bias. Again, then second is, this regret avoidance, painful history. I invested once in equity, I didn't make money. I invested second time, I didn't make money. Equity is not for me. So now that pain of making those couple of losses stays with me for so long that I decide to avoid it completely. But avoiding it is more regretting rather than, thinking about what happened, how you went wrong, and what is it that you could have done differently. So this painful history is something which I hold very close, which then stops me from taking more rational decisions. This is the other behavioral trap, very common for a lot of people. Similarly, some more, couple more. One is conservatism, sticking to your initial judgment. No, this investment is good. Now, there is new information which is telling you that this information is not something which is perhaps the best investment right now. But because I have decided, I will stick. Rigidity doesn't work in the markets. You have to be flexible. Similarly, representativeness. That stocks which are large cap, they will always do well, and you should not necessarily these stocks, mid caps, over a period of time, we have seen a lot of mid caps turn into large cap. We have seen a lot of small caps turn into mid caps, and then these mid caps move on to large caps. So, just because it is a big company, it is a large company, it is a high profile company, more in the news company, does not make it a good investment. Now we have to look at it from a valuation perspective. We have to look at it from various perspectives, and then basis that decide. So there's this representativeness. Now this scheme has performed well over the last so many years. It will continue to perform well. Not necessarily. It could be that some other scheme is doing better. So you need to make better informed decisions and not fall into these traps. And very honestly, we all need to overcome our biases. How do we overcome our biases? Very honestly, you should review your portfolios regularly. Break the herd, de-anchor, keep revisiting your biases. It's very, very common, very, very easy for us to fall back into this trap. And hence, it's very, very pertinent and important that I keep revisiting my biases to ensure whenever I'm making a decision, is this decision based on any bias? Is something which you should ask yourself. Finally, always remember that behavioral finance is a study which helps you understand your psychological influences and how they affect your investment decisions, which then affect market outcomes. And it's something where the more aware I am, the more probability that I'll be able to keep behavioral biases out and take better informed and rational decisions to help my investments create the optimal return that it has the potential for. This is what I had for all of us. If any one of us has any queries or questions, then I'll request you to please put it in the chat. Thank you. Okay, there is a question which has come that, there is this concept called goal-based investing where you invest basis your goals. And, over here, when I'm saying that, treat money as a fungible asset, then are we not going against that goal-based investing? So great question. and very relevant, because a lot of times we think we all have spoken about why it's important to have goals. Yes, it's very, very important to know how are you going to utilize your money, right? And that's perfectly correct. But at the same time, we need to also remember that money is fungible, and I need to ensure that my net worth is growing. Because if my money is growing, then, if I need money, it will be available. Point number one. Point number two, have I ensured that I have thought of everything and there is no surprise which will come? Because if any surprise comes or any shock comes, that will anyways throw my entire approach out. So yes, you should have goals. Ideally, you should stick with those. But remember that if I need money, I will take money from wherever it's available. And hence, don't bucket your investments very rigidly. That's what I'm trying to say. I hope this helps. Okay, another question which has come is, can you please explain the crash of 2008? The 2008 was a financial subprime crisis crash. Something happened in the US. At that point in time, India was predominantly an FII investment market. Although retail participation had started, it was not as large as in quantum as it is today. So what happened is, at that point in time, there was a lot of panic selling, and people were selling without realizing the biases, that they were having. So, there was, 2006, 2007, people were buying in herds. There was a bubble which was getting created. The bubble burst and the markets crashed. When the markets crashed, people would have stayed invested if they didn't need the money, but they sold thinking that the markets will crash further. And that is the reason why a lot of people made more losses. Had they stayed on, we all know that they could have recovered very quickly. And we've seen instances in data, in other presentations also that we have also made, that the recovery happens. So that is where it happens. So that is how it works. So there's another question which is being asked: which bias is most responsible? So there's no one bias, and if that would have been the case, I would have based this entire program only on one bias. That is why I'm saying there are different biases. At times we get overconfident, at times we hurt, at times we get very rigid with our investment decisions. It could be conservatism, it could be representativeness, it could be, how I'm looking at things, it could be me being very rigid with bucketing my investments, and hence it is very individualistic. I need to be very aware of the bias that is more overpowering to me and be able to control and curb that. That is important. Okay, great. As usual, thank you very much for your time. It was a pleasure. And we will continue to engage with you and share with you our thoughts on helping you make better investment decisions in the coming months as well. Till then, goodbye and take good care of yourself. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.